Okay, let's dive into this. Welcome to This Explainer. Today, we're unpacking the core philosophy of a guy named Benjamin Graham. He's basically the father of value investing. For decades, his book, The Intelligent Investor, has been the absolute definitive manual for building wealth. But let's be real, the original text, it can be pretty dense, kind of like reading a textbook. So today, we're going to demystify the stock market using a colorful playbook of real-world visual metaphors. We're stripping away all that confusing financial jargon to give you a clear, structured guide to actually protect and grow your money.
Section 1. Investing versus speculating. The sneakers or the lawnmower?
All right, so the very first thing we have to establish, and this brilliantly illustrates it, is the absolute crucial difference between gambling your money on hype and making a true fundamental investment. Imagine two teenagers, Leo and Mia. So Leo, he goes and buys a pair of limited edition sneakers for $300. He doesn't even want to wear them, right? And he has literally no idea about the actual quality of the shoe or the financial health of the brand making it. He's just crossing his fingers and hoping that in 2 weeks, someone on the internet will pay him $500 just because of the hype. But then we have Mia. She takes her $300 and she buys a 5% stake in her friend's local lawn mowing business. Now, this business has a solid mower, they've got 20 recurring customers, and it turns a steady profit every single month. That means Mia, she gets a small share of those cash profits every single week. No hype required.
So Leo is speculating, Mia is investing. Benjamin Graham defined the difference really clearly with this famous quote: "An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return." Graham warned that you absolutely must never confuse the two. I mean, speculation can be fun, sure. It's like buying a lottery ticket. But if you treat speculation as if it were actual investing, oh man, that is a guaranteed way to eventually lose your shirt.
Let's break that definition down into Graham's 3 mandatory rules for a true investment. Number 1, thorough analysis. You don't just buy something because it's trending on social media. You got to look under the hood at the real business. Number 2, safety of principal. You're making sure your initial cash isn't taking wild, crazy risks where you could lose 100% of it by tomorrow. And number 3, adequate return. You're aiming for a realistic, steady profit, not some miraculous 10x overnight explosion. I really want you to apply this so what check to your own money habits. Ask yourself, does this financial decision check all 3 of these boxes? Because if it doesn't, you're not investing, you're speculating.
Moving right along to Section 2, inflation, the silent thief, the villain under your bed.
So we need to talk about the hidden danger that absolutely destroys the value of your cash, even if you completely avoid the stock market and think you're playing it perfectly safe. I want you to imagine taking a crisp $100 bill. You fold it up, you hide it inside an old video game case, and you shove it way under your bed. You just leave it there, completely safe, for 10 long years. Well, when you finally pull it out, it's exactly the same piece of paper, right? It's still a $100 bill. But is it actually worth the same?
Now, what's really interesting about this slide is the invisible theft of inflation happening right in front of us. 10 years ago, that $100 might have bought you, say, 10 large pizzas. Today, because the cost of ingredients, labor, and transportation has gone up, that exact same $100 bill might only buy you 6 pizzas. It's wild, right? Your money has literally lost its purchasing power. Now, savings accounts are safe, sure, but they pay almost 0 interest, which means inflation is just slowly eating your wealth. Bonds are a bit better, but they still struggle to beat inflation over the long term. And this right here makes investing in stocks, actually owning pieces of real companies that can raise their prices to match inflation, a historical necessity to protect your future.
Okay, Section 3, choose your investment path, defensive versus enterprising.
Since we now know we absolutely must invest to survive inflation, Benjamin Graham outlines 2 very specific routes you can take. And you kind of have to decide which one fits your personality and your lifestyle. Let's look at the defensive or passive investor first. This is for someone who wants to grow their money steadily, but honestly doesn't want to spend their weekends reading boring financial statements. Graham's advice here? Keep it incredibly simple, with a 50-50 rule. You put 50% of your money into stocks for long-term growth and 50% into safe bonds for stability. And instead of trying to pick individual companies like Apple or Tesla, you just buy broad index funds. It's kind of like buying a variety pack of chips instead of risking your whole lunch on just one flavor. If one company goes bad, your portfolio is still perfectly fine.
And the ultimate tool for the defensive investor? It's dollar cost averaging. Guys, this is an absolute superpower. It simply means you invest a fixed amount of money, let's say $50, every single month, automatically, completely ignoring whatever the news says. When the market is booming, your $50 naturally buys fewer shares, which stops you from overpaying. But when the market crashes and stocks go on sale, your $50 automatically buys way more shares. You're systematically buying the dip without ever having to guess or time the market.
But hey, what if you want to be the enterprising or active investor? This is the path for someone who's really willing to put in serious research to find bargains and actually try to beat the average market return. Now, Graham warns this is incredibly hard, even for the pros. So if you take this route, you gotta follow some strict rules. First, entirely avoid social media hype. Popular stocks are almost always overpriced. Second, look for temporary bargains. Strong companies that are just going through an unpopular phase. And third, you have to do the math. You've got to analyze balance sheets to see what a company actually owns versus what it owes, and really scrutinize those income statements to find actual cash flow, not just clever accounting tricks.
Let's move on to Section 4, Surviving Mr. Market, the Emotional Business Partner.
Okay, this is arguably the most famous and definitely the most entertaining metaphor from Graham's entire book, and it perfectly explains the chaotic, everyday fluctuations of the stock market. I want you to imagine you own a business, and your partner is a guy named Mr. Market. Every single day, he knocks on your door and offers to either buy your half of the business or sell you his half. The catch? Mr. Market is wildly emotional. I mean, all over the place. Some days, he's ecstatic. He yells, "Everything is amazing!" and offers to buy your share for a ridiculously high $1,000. Other days, he's deeply depressed, crying that the world is ending, and he offers to sell you his share for just $10. Graham asks, would you ever let this manic-depressive partner dictate how you feel about your own solid company? No way. Of course not. You'd ignore his ecstatic moods, and you'd buy from him when he's depressed and pricing things dirt cheap. The stock ticker is exactly like Mr. Market. Do not let his absurd, emotional price swings change your view of a fundamentally good business.
Let's move to and see how this builds into Section 5, the margin of safety, the ultimate master shield.
Graham considered the margin of safety to be the single most critical concept in all of investing. It's your master shield against inevitable mistakes. So let me ask you a question. Imagine you're engineering a bridge. You do the math and calculate that the absolute heaviest truck that will ever drive across it weighs 10,000 pounds. Do you design that bridge to hold exactly 10,000 pounds? No. A smart engineer builds it to hold 30,000 pounds. You build an extra capacity, just in case a heavier truck crosses, or a crazy storm hits, or the steel rusts. That extra capacity, that is your margin of safety.
So the crucial point is how we apply this bridge metaphor to your money. In investing, a margin of safety means buying a stock for much less than its conservatively calculated value. If you do the math and find a company's true value is $100 per share, you don't pay $100. No, you wait for Mr. Market to get depressed and offer it to you for $60. Think about it. If you're right, you make a huge profit when the price corrects. But if your math was wrong and it's actually only worth $80, you still make a profit because you only paid $60. You've got a built-in safety net against bad luck and human error.
All right, let's summarize everything we've covered today into an ultimate whiteboard cheat sheet, perfect for teenagers and beginners to survive and thrive in the market. Number 1, invest, don't speculate. Buy real businesses with real profits, not just hype. 2, make friends with Mr. Market. Use his crazy price drops as store-wide sales, not reasons to panic. 3, use the power of consistency. Leverage dollar-cost averaging into index funds to automate your wealth. 4, always insist on a margin of safety. Never pay top dollar, always demand a buffer. And 5, control your emotions. At the end of the day, the biggest threat to your money isn't the market. It's the person looking back at you in the mirror. I want to leave you with this final provocative thought. Every single day, the market is going to test you. So the choice is yours. Will you let Mr. Market control your emotions and scare you out of your future? Or will you use his mood swings, demand a margin of safety, and build your own long-lasting wealth? The intelligent investor knows the answer. Take control of your financial journey, stick to the structure, and let time do the heavy lifting.
Please like and subscribe.